market wrap-up from the Fed's two-day meeting earlier in the week. As expected, the Federal Reserve Federal Open Market Committee voted to end the bond buying stimulus program, commonly known as QE3. The accompanying Federal Open Market Committee conveyed several upbeat signals to the financial markets that the Fed wasn't worried about global weakness, low inflation, or jittery financial markets. The Fed continued to use past language that rates would remain near zero for considerable time. However, they also stated if the economy improves faster than expected, then the first rate hike could come sooner than anticipated. The statement also made a major change to the Fed's view on the labor markets. Instead of stating there was significant underutilization in the labor market that was included in their September statement, the Fed said that the underutilized in labor resources is gradually diminishing. On inflation, the Fed said that the surveys are long-term inflation expectations have remained stable and low inflation has been held down by low energy prices, and the likelihood of inflation running persistently below 2% has diminished somewhat since the early year. In housing and mortgage industry news, the Mortgage Banker Association's weekly mortgage application surveys for the week ending October 24 showed that their market composite index fell 6.6% on a seasonal adjustment basis from the prior week. The seasonal adjustment purchase index was at the lowest since February of 2014. CoreLogic released their foreclosure report for the month of September 2014, showing that there were 46,000 completed foreclosures nationwide, down from the 86,000 in September in 2013. As September of 2014, approximately 607,000 homes nationally were in some state of foreclosure, known as the foreclosure inventory, compared to 924,000 in September of 2013. So with this information, as we've all said in the industry and experts as far as what mortgage interest rates are going to do, is the anticipation they have to increase. It's just been really surprising that they haven't increased yet. So I'm still saying take advantage of the opportunities that you have for purchasing. If you haven't looked at the opportunities for refinancing, rerun the numbers or take a look at that and see if it makes sense for you now before we see the increase in mortgage interest rates. The 30-year fixed rate over last week were around 4.25%, depending on the day. Obviously not quoting rates today. It depends on a lot of different factors, qualifying factors, credit score, income, and loan to value. But for example purpose or hypothetical purposes only, if we just take a look at 4.125% on a $400,000 loan amount, that would be a principal and interest payment of $1,940 a month. So if we just saw a 0.25% increase in the interest rates over the short term, let's just say 4.375, that would increase the payment to $2,000 a month. That's for the principal and interest, excluding taxes and insurance. So the difference with a 0.25% increase in the interest rate market would be $60 a month. And really what that means is you've lost buying power of maybe about $10,000 a month. Depending on your down payment, that calculation is going to be a little bit different. But $10,000 additional in property is substantial. And in some situations, it's going to make or break you being able to get into the neighborhood that you want to for your family. Now, the anticipation is high 5s to 6% before the end of 2015. So let's just say the rate went to 5.75%. That on a $400,000 loan, that would be a principal and interest payment of $2,335. The difference being $395 a month. So almost $400 an additional a month in your mortgage payment. Now we're talking about an additional $60,000, give or take, in buying power. Substantial difference between taking advantage of the opportunity that you might have now with the interest rates as low as they are. Now, also, you've got to consider the appreciation. My guess, and I'm sure my real estate experts in studio would anticipate as well, that we're going to continue to see some appreciation over the next year. And on a $450,000 home, just at a 1% appreciation, it's $4,500. So every 1% the market increases, that's an additional $4,500 that you're seeing, or 25 increase in your mortgage payment. So again, the opportunity to get into the market is really good right now. Things have slowed down a little tiny bit from what I've seen with my buyers. Some of them are jumping off the fence, and just basically meaning that there's not as many multiple offers, which actually can be a benefit, even though it's slowed down a little bit. That could be on a positive side for you as a buyer, higher because you're not competing in multiple offer situations on some homes. Now, there's still a lot of them where you're seeing multiple offers, but with that, in multiple people making an offer on the same home and trying to negotiate the best offer, ultimately you're going to pay more for that house. So again, get out in the market, take advantage. If you have any questions, feel free to give the show a call, 1-855-400-1150. Again, that's 1-855-400-1150, or you can go online to themoneyhour.com. And coming up next on the Money Hour, one of my trusted resources, two of my trusted resources are right here in studio to talk on our local real estate market and advice for buyers and sellers. Stephanie McCarthy and Heidi Braun with Real Living Northwest Realtors right here on 1150 AM KKNW after this short break.